Afternoon, everyone. Good to be back in the classroom doing this, but welcome to the April FOMC Fundamental Trader Prep. Now we are going to do this over 2 days. I'm going to do all the fundamental stuff today. Brannigan will go through tomorrow with you some trade plans and some of his ideas. So we've sort of got the tag team back as we had previously, maybe not together today, but simply more so because Brannigan's otherwise engaged, so he will be back tomorrow doing the trade plans and so on and so forth. So April FOMC, as with always with Fed meetings, they actually take place over 2 days. First day today, then tomorrow again, and then they release the following at 7 p.m. UK time, so British Standard Time. They have any announcement in the change in the Fed funds rate. Nothing's expected this time. Any announcement of any QE or tapering, and then they have a statement release. Now, it's not always the case we have this format. Obviously, every other meeting we have press conferences with Yellen and a Q&A, etc., and updated dots, economic projections, and so on and so forth. This meeting, we don't have that. All we have is essentially rate decision and statement. That statement gets released, however you're looking at Bloomberg dump, Reuters dump, highlight what you need and what you need to be aware of or what you're looking for. But at 7 p.m. UK time or 2 p.m. Eastern time, the statement will be on the Fed website. So I've sort of gone through the meeting format, but what else are we going to look at today? Our objectives, going to look at what the Fed mandate is. It never changes, hasn't changed, so you should really all know that off by heart anyway. We'll go through what happened at the previous meeting, touch upon the statement, the minutes, and some of the market reactions. We'll then look over the data since the previous meeting, and then on to market pricing and expectations. It's always very important to know what the pricing is and the expectations are, so we know when something is a surprise or when something is expected, because obviously when the market is surprised is when you get the good market moves for us as traders. When the market is expecting something, it's a bit of a damp squib, and it's not necessarily what the analysts are expecting, it's what the market is pricing and expecting. There's often a disconnect between the two, so the market is obviously more important. And then finally, we'll look at some key focus points from a hawkish, dovish, neutral standpoint, things you should be looking out for in the statement, more in terms of the wording, the forward guidance, and what the Fed essentially are looking at when they are looking to implement policy or move interest rates. Okay, so the mandate, we should all know this, it doesn't change. It's to support continued progress towards maximum employment and price stability. Essentially, dual mandate, inflation, employment. A lot of central banks have purely an inflation mandate. The Fed never had an inflation mandate. Actually, in the past, it was just an employment-based mandate, but post the financial crisis, they brought inflation into it, and it is now a dual mandate of maximum employment and price stability, i.e. inflation. So what happened last time at the March meeting? Okay, rates were unchanged as expected. It wasn't unanimous, as was the case in January. This time, I think Kansas City Fed President Esther George dissented in favor of a 25 basis point hike, so it wasn't unanimous. So that's something we need to maybe try and pick up on at this meeting, whether there's any unanimity or if there are more dissenters in favor of a hike or even a cut. You never know. So the market took it as a kind of a dovish hold last time round, simply because of the fact that the Fed median dots were cut quite significantly from December to just 0.9%. So it was 1.375% median for 2016. It was cut last time round to 0.875%, so implying 2 hikes this year as opposed to 4 from the December projections. This time round, obviously, we don't have any dots, so we can only go based on what was given to us last time. Last time also, we had updated inflation projections. They were cut to 1.2% versus 1.6% prior, and GDP projections were also down for 2016 to 2.2% from 2.4% prior. The Fed in their statement did acknowledge that inflation picked up in recent months but continues to run below longer run objective. That's been the case for a while, and also for a while they've said inflation is to remain low in the near term, partly due to energy. We know that again, oil prices in particular. And the Fed did say that they want to be careful about avoiding a major inflation overshoot. So they were worried about inflation potentially becoming too high in the future. And actually, in the minutes here, this very bottom point, they reveal voting members were more concerned about higher inflation than low inflation, which is something quite telling and maybe a guide as to where policy might go. But just to finish off the points from the last meeting in the statement, the Fed signaled concern on economic developments and recognized essentially the ongoing risk to the economic outlook posed by soft global growth and financial market volatility. So essentially, they've been worried about the global economy for a while, whether it be China, whether it be oil, whether it be the emerging markets, equity markets, whatever it might be, and this hasn't gone away for them. They're still concerned about these things, even though from the January to March meeting, things had improved slightly. In the Q&A, interestingly, Yellen did mention April remains a live meeting, so as in this meeting is a live meeting. And the minutes did reveal not just one member was in favor of a rate hike, but more than one, but that other one must have been a non-voting member. It could have been two non-voting members, we don't actually know, but they mentioned there were a number of board members in favor of a rate hike. So given that they only said one dissented at the March meeting, this must be a non-voting member. But the non-voting members still have input into the meetings. Okay, if anyone's got any questions, feel free to just put your hand up and ask. Okay, so the reaction, yeah, Ross.
That's a quick one. I can't remember how often do the voters get changed?
Every year.
Every year?
Yeah, every year. The voters get changed every year. So I think from last time there was Kokolakota dropped out and he was the ultimate dove, but there was a very hawkish member, I can't remember which one dropped out, so it kind of balanced things off a little bit. Okay, so in terms of what happened, how did the market react? Well, it was, although rates were on hold, it was very much a dovish meeting, and we got some quite violent moves. So to start with, the stirs, as I generally look at first and foremost over central bank meetings, we actually saw in, and I'll bring a chart up here, the DEC 16 stirs, we actually saw this here. In the month leading up to it, the stirs sold off pretty much every single day, gradually dripped down and down and down. I mean, the end of January was when we had all that financial market turmoil, when we had some big moves. So stirs had sold off DEC 16, yields essentially bounced because of the inverse relationship between price and yield. But then on the meeting day itself, we got essentially a 16 basis point rally in the stirs, which is a big deal. Like a volatile day in the DEC 16s maybe is 4 or 5 basis points. So 16 basis points, 32 tick, essentially straight line up move on the back of what happened last time. And that was essentially because the Fed dots had moved so significantly from projecting 4 rate hikes to only 2. Now the market at that time wasn't projecting 4 rate hikes, they were more like 2. But the fact that the Fed had changed and shifted their projections down so much, the stirs moved quite violently, and that's this candle here. So in the context of things, it's pretty big, and in the stir market, it really is pretty big. So that's what happened, essentially, a knee-jerk reaction in the stirs. In the bonds, treasuries rallied hard, very hard, with the 2s through to 5s rallying over 14 basis points from pre-FOMC levels. And what the most interesting move actually was in the yield curve, with 530 steepening over 13 basis points from session lows. So if I bring that chart up here, this is the 5-year yield, dropped 14, 15 basis points. Over here, maybe I can shift this up higher a bit, is the 530s. Now you can see 16 basis points in the 530s just does not happen. This really is a rarity. We were at our flattest point to start with over the last year or so, but 16 basis points is a huge deal. What does that mean? So if the 5-year moved 14, 15 basis points, it essentially means the 30 years hardly moved for that to happen. So and what happened is the 30-year yields on that day, change on day was 0. So an ultra dovish Fed, but the 30-year did not move. It was the 5-year that actually led the shorter end that led the move. I think the 10-year yields were moved about 7 to 8 basis points, 5-year 14, 15, the STIRS 2-year around the same. So essentially the short to mid part of the curve moved a lot, the long end didn't do anything. And that's why you got this pretty violent steepening. And that was probably the most, I think that was the most interesting for me from that meeting in terms of market reaction. Okay, equities had an initial blip up in the S&P, and then we retraced approximately 50% of the move in the next 10 minutes before moving higher over the session. If I bring the chart up of the S&P, essentially this here, this is a 1 minute chart, 15 handles higher, pulled back in the next 10 minutes, and then just ground higher and just chopped around into the close essentially. And that's probably what you'd expect on a dovish Fed, that the equities do go up. It was a dovish Fed that was, the markets behaved as you would expect. Sometimes on dovish Feds they can throw a few curveballs in, but by being upbeat on certain things, but they were essentially, rates are on hold, they're going to stay on hold for a while. There was nothing that indicated that bond markets should sell off, equity markets should rally, should sell off as well. And then finally in FX, I'm not going to bring a chart up of it because it's not that interesting, but the FX, we did have a knee-jerk move lower in the dollar as you'd expect. Against the euro it was about 150 pips, and then we balanced for the remainder of the session. So always, when we go into any Fed meeting, it's always very important to know what has gone in the previous meeting and previous meetings in terms of market reactions, because I've gone through what happened last time, but you should be going through what happened last time, the time before that, because you'll pick up correlations with bonds and equities. You'll pick up, well, what happened when the Fed were hiked rates and had a little dovish slant at what happened when they kept rates unchanged but were quite upbeat. And it's basically, history does repeat itself, so it's really important to do in your preparation the scenario analysis, and the best scenario analysis is based on what's happened in the past. So go back over the last 12 months and see what's happened at every single meeting, and how the market has reacted, because you always, this whole trading business is about pattern recognition, and it's recognizing patterns and implementing process that will ultimately enable you to make money. So that's important, obviously. What else is important? What's changed over the last month? How's the data come in? And data's been okay, to be honest. Some bits have been fairly strong, some bits less so. NFP last month was a small beat. Early this month, it was on the 1st of April. Small beat. Average hourly earnings was up, which is important for the Fed because that's kind of their employment gauge towards inflation, and the unemployment rate was unchanged. PMI manufacturing's slight beat. The CPI numbers, and this is probably the most significant, were slightly below expectations, both for core CPI and core PCE. Now, Fed have had their dual mandate for a while, and employment's never really been the problem for them. That's been, I'd say, pretty solid for the last 2 years or so, and it's always been inflation that's been preventing them from hiking rates, because they haven't seen the pickup in inflation that they'd probably expect and might want. So that would be the key thing, really, that inflation hasn't really ticked up, and it's been very slow to do so. The Fed would definitely want to see these numbers rising. But having said that, I haven't put the numbers here, but year-on-year inflation is much closer to 2%. This is just the month-on-month number. Core retail sales slightly lower than expected, 0.2%, but higher than the previous month, which was flat. And GDP, final GDP, was much higher than expected at 1.4% versus 1%. So that's really the key data over the last month. I've also have bullets here for China as well as oil and dollar performance, but I will go into those later, because although they're not data points, they're part of the whole global developments and that the Fed are a bit closely watching. So that's important for us to watch as a result. And this chart here is just the March versus December dot plot. And why I bring this up is because I'm going to go into market pricing now. And what we can see is March to December, March in green. Sorry, December in green. December to March rather. December in green, March in purple. We've seen the dots are much lower. These purple dots are much lower than they were in December. And essentially we're only really concerned about 2016 now, because everyone wants to refer to when the next rate hike is. No one's really that bothered about what's going to happen next year, the year after. Everyone's kind of looking at what the Fed are doing now, when they're going to move rates next, how quickly. So this 2016 more is about the timing of the next rate hikes. The 2017, 2018 is much more about the pace of rate hikes and how they go about it. Is that all very clear? Good. Okay, so market pricing. You should all know this, but the current Fed funds target is 25 to 50 basis points, and the current rate within that target band is at 37 basis points right now, so it's pretty much bang in the middle. The market is pricing a 0% chance of a rate hike for this April meeting, which is pretty interesting, that nothing is priced, given that last time round Yellen had said the meeting is live and every meeting is live. So if you do want a cheap punt, then you're not going to lose much by being short some maybe very short dated stirs going into this, just in case they do hike. I mean, they're not. I don't think they're going to hike, but you know, if there's anyone even remotely thinking there is a small chance, then it's a no-brainer to do that sort of trade. And that's kind of looking at risk reward. Market's not expecting anything, so if they do hike, it's a huge surprise, and that's when you get the biggest moves. And those sort of trades you can do in the stirs and pre-position. I wouldn't do those in the bonds, I wouldn't do those in the equities, but possibly in the stirs. So nothing is priced for this meeting in terms of rate hikes. The next hike is fully priced for October 2016. So looking at current market pricing, 60 basis points is what the market is pricing for year-end rates. Now that's about one hike less than what the Fed dots imply. So essentially the Fed is saying they may raise rates twice in 2016, the market's saying one. And as we look at 17 and 18, the market essentially expects a slower pace of rate hikes than the Fed going forward. Fed's talking about, purely on the dots, going from 0.875 to 1.875 is 1%. Typically the Fed move in 25 basis point increments, so that's 4 rate hikes. Now the market is essentially saying 0.6% to 0.87, which is 1. So it's a lot slower, the pace is a lot slower. And similarly for 2017 to 2018. And just as I mentioned previously, the market pricing into the last meeting in March was a lot higher than it is now. Why? Because the Fed guided us down last time round. They downgraded all the dots, so we've got significantly less priced in now than we did in March. But there's still a big disconnect. Dec 2018, Fed median dots 3%, market median dots 1.05%. That's 2% difference. But like I said, the market's really most interested in 2016 at the moment, and that's what the pricing we're looking at. Any questions? Okay, good. So we look at market pricing, one, to know and think about what will happen if they do raise rates and what the reactions might be. But two, it's always important to know what's expected, what's a surprise, what's hawkish, what's dovish, what's neutral. The market pricing is only reflecting that in terms of pure interest rate moves, in terms of rate hike, no rate hike, but we can bake in expectations as to how the meetings might go and what guidance we're looking for. So if the market is not looking for a rate hike till October 2016, what are we looking for within the statement that comes out? We're looking for indications that it might be earlier, it might be later. October 2016 is when the market expects, so we're looking for some deviation, some guidance from the Fed. So the key focus points for me in the statement, first regarding the actual announcement, then the economic outlook, then the language and forward guidance that they provide us with, and then their view of the global outlook. So the Fed funds rate announcement. Obviously there's going to be an announcement, expected to be no change. So if there is no change, the next thing we look at straight away is a statement. And their references potentially to the path or to the Fed funds rate in the statement. So last time round in the statement, it was said the committee decided to maintain the target range for the federal funds at 1/4 to 0.5%. Now this will be exactly the same if they don't move rates. And if they do, you don't even really need to pay attention to this statement because you would have heard the number before. This is maybe what's more important if they don't hike rates, which is what's expected. So in determining the timing and size of future adjustments to the target range for the federal funds rate, the committee will assess realized and expected economic conditions relative to its objectives of maximum employment and 2% inflation. So essentially they're telling us what the conditions are for a future rate hike. Again, these conditions are unlikely to change, but they might. They might add something, they might take something away. And that's again, that would be a surprise. So you have to do your, I'm not going to do it for you, but you need to do your own scenario analysis. What could be hawkish? What could be deemed dovish? What is neutral? These two things essentially for me are neutral. So you need to think about scenarios where these things could change and be more hawkish or more dovish. So essentially, we'll get a rate hike tomorrow if the Fed believe the above conditions are met. Objectives of maximum employment and 2% inflation. If it's met, they'll hike. If it's not, they'll pass it to the next meeting or the next meeting. Obviously, we've said the markets, based on the stirs, is saying no chance. And then unchanged rates, it's essentially the consensus view, and using Fed funds data, which I look at to look at my market pricing, no hike has been delivered unless the market was pricing at least 60% or higher. Now, if we went back to the December meeting when they hiked rates, there was about an 85-90% chance priced. When they didn't hike rates in October, there was about 40-50% chance priced. So that's not to say just because it hasn't happened in the past, it won't happen. But it's all about the context. But if a rate hike does come tomorrow, it will definitely be a surprise. Okay, so that's the stuff about the rate decision and information regarding the actual interest rates. Now, the economic outlook, what are we paying attention to? Obviously, the dual mandate is inflation and employment. I'll start with employment because it's the least important. It does seem to be something the Fed are happy with. Last time they said labour market conditions improved further even as economic growth slowed late last year. And they said the range of recent indicators, including strong job gains, points to additional strengthening of the labour market. I mean, if I'm honest, for the last few meetings, the last year even, analysts, us as traders, haven't really focused on the employment stuff within statements because it's been going along nicely. The Fed have said it's not really been a concern. Hence, for that reason, where's our focus? Inflation. Has the medium-term inflation outlook changed? About 6 months ago, maybe they often use the term that the Fed are reasonably confident. inflation will return to target. It hasn't been there for a while. Now, if it does come back, that's very hawkish. Last time, what did they say? They said inflation picked up in recent months. However, it continued to run below the committee's 2% longer run objective, partly reflecting declines in energy prices and prices of non-energy imports. So that's part of their guidance regarding inflation. The other bit they said was inflation is expected to remain low in the near term, in part because of earlier declines in energy prices, but to rise to 2% over the medium term as the transitory effects of declines in energy and import prices dissipate and the labour market strengthens further. Now, where could there be changes here? Do they still expect it to remain low in the near term? Do they still expect it to rise to 2% over the medium term? Are these declines in energy prices transitory still in their view? Has the labour market strengthened further? I think, like I said before, I don't think that's overly important. But these other things will really contribute to the Fed's decision making, whether it will be now or at the next meeting or at the next meeting. So you really do need to know this stuff, and this shouldn't be new to you. Every meeting we go through this, and it's just subtle tweaks in what they're saying. We always hear Fed speakers as well, we hear comments from the Fed, we hear what Yellen's saying, we should be reading stuff. So none of this should be a surprise. This should just be recapping what you already know. But it's essentially the statement science, knowing what's in the statement, where it is, how it might change, and then having your own scenarios of what would be hawkish relative to this, what would be dovish relative to this, what actually is not important at all relative to this, because they do tweak things, and it's always subtle changes, that aren't always the easiest things to pick up on. Well, they're not going to be easy if you haven't prepared for them, but we are smarter than the average Joe out there, and if you prepare for these events, you can make good money off them. But preparation is everything. It's not like the ECB where their statement is read, because it does come in a difficult manner as a screen dump. But if you know what you're looking for, then it's a lot easier to trade. Okay, so that's the stuff about the economic outlook we should pay attention to. Then the language and the forward guidance. And for me, at meetings where interest rates don't change, this is what's most important. If the Fed keep rates on hold tomorrow as expected, this is probably the most important thing. We've already touched upon it, but in the last statement they said the committee will assess realized and expected economic conditions relative to its objectives of maximum employment and 2% inflation. That is the number one. Clearly, that's their dual mandate. Last time they also said the committee expects that economic conditions will evolve in a manner that will warrant only gradual increases in the federal funds rate. So the point above is more about when they will hike rates. This point here is more about the speed that they'll hike rates. And then the last point, the actual path of the federal funds rate will depend on the economic outlook as informed by incoming data. So essentially this last point sums up both when the next hike will be and the speed. So this is really important in terms of the forward guidance stuff. So in terms of when the next Fed hike is, things to look out for in the statement: is there any mention of the June meeting? Is there any mention of the next meeting? Because actually, when they hiked rate in December, in October, the meeting prior to that, they explicitly stated, at our next meeting, we will consider this. Which essentially made the next meeting very live, and the market priced it accordingly. Now, if they say this, you're not going to see the market price it then. They're going to price something now for the next meeting. So that's very important. That's about the next hike potentially. The pace. So they've said that we'll expect only gradual increases in the Fed funds rate. Now, will that change? Will they say we expect to get a measured pace, have gradual normalization, very gradual? These are all different terms, When they hiked rates years ago, they used the term measured. Measured mean 25 at every meeting. Now, very gradual. They've only used the word gradual at the moment. So even if it's a subtle thing to say very gradual, that's already very gradual is obviously more gradual than gradual, if that makes sense. So that's, it seems very trivial, but these trivial things you can actually make money off. And not knowing that they only said gradual last time and this time they said very gradual, not knowing that is opportunity cost. If you don't know that, you can't make money out of it. So we know the current stance is gradual increases. Any changes, whether it would be very gradual, whether it would be measured, which is probably quicker, these are opportunities. But again, do your scenario analysis. What will I do if they say this, they say this, they say this? Some instances you'll do nothing. A lot of instances you'll do nothing. But if you haven't prepared, you don't have a chance, because it's hard enough. It's hard enough as it is. If you haven't prepared, you'll be too slow to the party. They've always had, up to now as well, this continued emphasis on data dependency, irrespective of the rate decision. They've always talked about the data will depend on the economic outlook as informed by incoming data. Us as traders, analysts, they're always asking about when the next meeting is, what day, is it March, May, June, July, September. The Fed don't care. For the Fed, the next rate hike will come when the data warrants it, and that's not calendar dependent. But ultimately we know when the meetings are, so we trade accordingly. But if the data is turning for the better, inflation in this case, because that's their more of their concern, then that rate hike will come sooner. The market will price it in quicker. You get more volatility the sooner that rate hike is priced. What I would say is to look at other statements previously, but in particular the October statement, because the October one was one where they used this term of next meeting. The October one was the meeting before a rate hike. So maybe have a look at what the terminology was in October, because according to the dots, and the dots are only a gauge and only a projection, there needs to be 2 rate hikes this year, according to that. Now, this is our 3rd meeting of the year. There are 8 a year, so assuming they do nothing here, it essentially means if the dots are to be believed and the projections are to be believed, out of the next 5 meetings there will be 2 rate hikes. So that might be in June. One of them might be in June. We don't know. But that's why refer to the October statement and see what the wording was like, and then it might give you some clues as to things to look out for. And I think that's the really, really important thing. If I say there's one thing to take away from what I'm talking to you about, is go away and look at that October statement. It might come to nothing, but again, if you don't prepare, then you won't be able to take advantage of the opportunities out there, because it was a very different statement to a lot of the statements we've had. Okay, and then finally, global outlook. That will be in the forward guidance as well, and I've sort of dedicated a little section to it on its own because it's pretty important. So although we've said the Fed have mandates of inflation and employment, you could probably add a 3rd soft mandate out there as well, the global outlook mandate, because they said this last time: the global economic and financial developments continue to pose risks, and they say that economic assessment will take into account expectations and readings on financial and international developments. So it's almost like a third part of a mandate, even though it's not fixed there within their normal Fed speak of what their targets are. This is clearly important to them. So in terms of looking at the global outlook, let's look at China. So let's look at China. Shanghai Composite. Hold on here. Still, still fairly weak, but since the last meeting it's been pretty stable. over the course of the year, it's generally been grinding upwards. So since the last meeting, Chinese equities, they've done okay. They've had a bit of a dip in the last few days or so, but generally they've been fairly stable. That in January and end of last year, obviously we saw this move, but now, you know, it's not significant, but things are doing okay. So that's not really a concern. That's better for them than last time around. If we look at the Chinese currency, the yuan, again, it seems to have stabilized a little bit after having these kind of big up moves. This is against the dollar, or dollar yuan. So actually this is Chinese yuan weakness, this upward move. So this is strength when it goes down, because the dollar is the first currency quoted again. So that's fairly stable. That will be pleasing in terms of the Chinese economy. Okay, so China's more stable. Emerging market currencies are more stable. I'm not going to bring that up. I think China's a good reflection of that. Dollar strength, that had been a concern for the Fed because the strong dollar has implications for growth and inflation. A strong dollar essentially with weak global demand, which is what we've been seeing from what other countries are doing. Europe's been weak, China's been weak, UK fairly weak, you know. Weak global demand with a strong dollar essentially imports disinflation. So if we look at the dollar, we look at the dollar index, the dollar has actually been weaker than we were at the time of the last meeting, and actually this will please the Fed as well, because this is the dollar index. Still, you know, still fairly high relative to where we've been, but it's much more stable, and it's been coming off gradually over the course of the year, and that's probably been because the Fed have been dovish. So the Fed have obviously contributed to that themselves, but this will please the Fed. So this is another point that one of those concerns that the Fed might have had has diminished slightly. So Chinese concern diminished slightly, emerging market concerns diminished slightly. Dollar strength, clearly it's not stronger, it's weaker than where we were at the meeting in March. So that's concern has diminished slightly. Okay, so if we're looking at equities, that was also a concern to them at some points. S&P, they're near the year highs now. Where were we in March? March 16th, we were 9 handles lower. Again, so equities have only been one way since about mid-Feb, and pretty much one way since the last meeting. So again, this is something that will please the Fed. So there are a lot of things among these global concerns that will please the Fed. But remember, everyone knows this. We're going over this now, but we know this. The average Joe out there will know this. Analysts will know this. Other traders will know this. So what do you think people might be expecting? For some of these concerns to the Fed to acknowledge that they've diminished, do you reckon? Yes? No? Okay, yes. So you say yes. So if these lines still are there, that's pretty dovish, right? Just because it was there last time and it comes up again doesn't mean it's nothing new. There's probably people out there expecting that these lines about global financial developments continuing to pose risks. Yeah, sure, they still pose risks, but they may expect them to be a bit more upbeat about it. But if they're not, then that's dovish. If they have exactly the same lines, that's probably a bit dovish, because we can see China's doing better, equities are doing better, emerging markets are doing better, but the Fed's view hasn't changed. So I'm saying this is one scenario that you need to prepare for. Because sometimes statements being exactly the same can still be hawkish and dovish if they're expected to change. So don't get caught out by that. Just because something is the same within a statement doesn't mean that doesn't provide opportunity. So US equities back to year highs. Oil and commodities. So So oil is back to 6-month highs. Still in the bigger picture, very, very weak relative to where it's been, but obviously since mid-Feb we've kind of bounced a bit, and definitely since the March meeting we're higher. Not much higher than since where the March meeting was, but we are higher. So why is this important? Because low oil prices were contributing to this weak inflation outlook. Low oil prices, inflation lower. Inflation is the definition is, a rise in the general price level. So when prices fall, inflation falls. Now, because the Fed have said that the oil prices being low is transitory, or they believe it's transitory, this might justify that, because we've seen the lows and it's creeping up slowly. So maybe it is transitory. But then if it is transitory, we'd expect to see inflation tick up soon enough. Again, so that's something else to look out for. Oil has bounced a bit, but we haven't seen inflation bounce yet. What's the Fed's view on that? Yeah, Russ.
It's could be slightly not off topic, but a bit of an out there question. Where do you think the Fed are going to sort of agree that the transitory effect has passed? Do you think it's when it sort of hits $50 a barrel and becomes the point for sanctions?
Yeah, that's a good question actually. The honest answer, I don't know. But again, that is something to look out for, because they've never really provided us with that guidance. But probably, to be honest, probably if this low has formed, if it is a low that's formed and we don't get anywhere near there again, they'll probably say that the transitory period we're still in transition. But generally with inflation numbers, they're looking at a year. So they're looking at it month on month, but ultimately when they look at their numbers near 2%, they're looking at yearly inflation. So maybe it needs to be a 12-month period.
Yeah.
So maybe that's the period of time after 12 months. So, we're probably, when do they start discussing this as a bit of a concern? Probably third quarter of last year, so maybe in another 3-4 months. Then that will probably be the time where they look at, is it transitory? Because actually when they started talking about oil being low and transitory, it was when it was probably at about $37, $38. It's not actually, it's only $7 higher.
Yeah.
But obviously off the lows, it's $20 higher. So that's a difficult one. It's a good question, and I don't know is the answer, but that might be some guidance. Probably that's probably more in terms of what might come up in the minutes, given that there's no Q&A this time. But yeah, it's a very good question. But yeah, in terms of, they might refer to the word transitory. We've seen it before in the statement. Is it still transitory? We don't know. And then finally, it's not really a global outlook thing as such, but the US economy is the exception. They're talking about hiking rates. Everywhere else is easing. ECB, have been easing. RBA have been easing. Japan have been easing. Pretty much every country out there has been easing, apart from maybe the UK. I can't actually think of one country in the developed world that's hiked rates in the last couple of years. Fed have hiked once, and they're looking to do it again. And why I mention this is, if everyone else is easing and the Fed are looking to raise rates, that's going to have dollar implications. That's going to strengthen the dollar. Higher interest rates in the US relative to somewhere else, dollar strengthens, and that's what the Fed will want to be careful of, because naturally when other countries cut rates or ease, embark on QE, the dollar strengthens because of what they're doing, and then they're going to strengthen it themselves, so they need to be careful as well. So they are the exception as opposed to the norm, and that is something they'll take into account indirectly, just the impacts of the dollar, because as we said here, strong dollar with weak global demand is weak because others are easing, will import disinflation to US. So that's something they'll want to be wary of and take into account. Okay, that's pretty much it from me. Has anyone else got any questions before we wrap up? Okay, good. So, well, obviously this stuff here that I've been through is the fundamental prep. This is more the fundamental side of it. I haven't really gone through any trade plans, trade ideas. This is the stuff you need to know before you even formulate your trade plans, because you need to know what you're looking for. You need to know what the Fed funds rate is, what the mandates are, how much is priced in. You need to know what the statement's referring to. You need to know about the gradual word. You need to know about what the objectives are. You need to know about the data dependency. You need to know about the transitory. Or you need to know all this stuff to be able to plan your trades. Because in volatile events, technicals go out the window. You could be, as you all know, you've seen enough now to know that actually technicals generally hold on a normal day, but not a risk event day. Sure, technicals will hold, but you might have a support level, but it might go through 4 supports before it bounces at the 5th support level. So it's important to have your levels as well, where your supports and resistance are, but ultimately this stuff for risk events is more important. And then once you've done your scenario analysis, you can formulate your trade plans. And tomorrow, Brannigan will, at 45 tomorrow, go through trade plans and what you should be looking at, go through some setups, some structures, some market structures, and how you should even set up your ladders and what you should be looking for. It's not easy, but it's not trading is not easy, but this is where we can have an edge. It's hard on algo-based events, just economic data, and okay, it's not like the ECB where the statement gets read out, but if you know the statements, if you know what the changes might be, if you know your hawkish, dovish, neutral scenarios, you will have a much better chance of succeeding. And remember, just advice from me, if there's something you haven't thought of, you don't have to trade. Trade to your plans, because just because something's moved 20 basis points or 20 handles in the S&P doesn't mean you just get in the way and fade it or go with it. You just it's all in the context of your trade plan. So some of you might not, and probably a lot of you actually won't even trade in the 10-15 minutes afterwards. You'll wait till the markets normalize a little bit and then let the markets tell you where the supports and resistance are, where the pinch points are, where the stops are, and then you might get involved on the back of it. But some of you will be all over this stuff, will be, have plans on what they'll do if they change the wording from gradual to very gradual, what they'll do if they hike rates, what if they say they'll do something at their next meeting, or even not even do something, just mention explicitly next meeting. But definitely go away, look at the last statement in more detail, look at the October statement, which I think is a very good guide as to what might come. It might not be the guide for what might come in the June meeting, but it will be useful nevertheless. Okay, so go away and do your own preparation, and then you got Brannigan tomorrow for trade ideas and trade plans, and please also do be ready to contribute with your own ideas tomorrow. Great, thanks very much. Have a good evening.